a lot of mixed mistakes what you do or whatever, those are price you pay for learning, right?
Next question is, would you mind disclosing your current personal portfolio allocation?
So actually I started my journey I never thought I will be a fund manager.
We are honored to host Mr. Mahesh Patil, CIO of AMC Limited. The firm currently manages 3,50,000 crores. Welcome to the show, sir. It's an honor to sit right next to you and have this discussion.
Sure.
So first I want to know more about yourself. So how did you end up in the fund management space, and how did you know that this is what I want to do for the rest of my life?
Right. So I think it all started actually from being passionate for equities and doing research, right? So one had an analytical bent of mind, right? I mean, I've done my engineering, right? So I thought this was a great field where you could apply your knowledge, also technical knowledge, as an analyst. There are a few sectors, right, where you require to understand the industry, the sectors, your technical knowledge, and having done my MBA, right? Okay, you apply a financial knowledge to find values, right, in companies. So actually, I started my journey I never thought I will be a fund manager. It was more about researching companies, analyzing companies, right, and trying to see, okay, where there is value. So that was interesting journey. And then during the course of your journey, right, once researching, being a good analyst, then got an opportunity to work on the mutual fund side, right, around in 2005, okay, where I started managing funds. And that was a different ball game altogether, right? Because again, there was always a passion on equities, right, which is there. I remember got introduced to equities during 1993, and that was a golden era, right, where you saw the whole liberalization and the emergence of the equities, or that time when formally SEBI regulatory environment came in, and that was a period where India moved into the period of a lot of big ticket reforms happened, right? So all that, I witnessed that, and also started investing into the market personally, but really formally into the fund manager in 2005 in Birla mutual fund, when I got an opportunity to invest, to join that. That's where I started managing money, and it was a great experience where you could actually invest, right, what your recommendations, what you're doing as a research analyst, implementing it in the portfolios, and seeing the rewards coming in over there. And also, again, when you are working in a professional setup, you also get to learn also from your colleagues and the whole team which is there, right? And since we are working on various the team members, not only on the equity side, on the debt side and the macro side, you get a good overall perspective. And touch wood, I think in that period we did very well, right? I mean, 2005 again was a great period for equity, right? 2005, 6, 7, 8 we saw, and during that period India was in a boom for investment-led boom which was there. That was a period where you saw a lot of capital good infrastructure companies doing well, and I had a good understanding of that sector, right? I was an analyst for that sector for quite some period of time when I worked with, say, Parag Parekh or Motilal Oswal Securities. So that's how the journey has been. I think you learn on the ground, right? You start learning on the ground, you look at your peers, and that's been a journey in the last, say, 18 years at Aditya Birla Sun Life Mutual Fund.
With around 3 decades of experience in the industry, your journey speaks volumes about your understanding about the market dynamics. So, reflecting on the vast experience, what do you think is your biggest learning from the markets?
So, I think markets, there is every learning experience, right? Anything, every day the market is teaching, right? A lot of mixed mistakes what you do or whatever, those are price you pay for learning, right? But some of the learning I would say is that I think sticking on to your winners. In the market you will invest, there are certain stocks which will become very large winners, multi-baggers for you. There will be certain stocks, okay, which will not do as well. But I think holding on to your winners, when you identify a good and a great company, holding on to it and sticking to it and letting it really play out, I think that's where real wealth gets created. Sometimes there's a temptation to sell, right, because the stock has run up by, say, whatever, 100% or doubled that returns. There's a temptation to sell that, but I think once you identify a good stock, I think it's holding on and building on that compounding for a long term is where actually you make big money. And at the same time, there are also laggards in your portfolio, right? There are losers in your portfolio. The sooner you cut those losses, I think the better it is, right? Sometimes we don't want to cut your losses because you think that they will bounce back in the matter of hope. So there's no point in trying to hope things will
maybe
improve.
emotional attachment towards that.
Try to cut your losses because there's an opportunity cost also. There's a money which is opportunity, money which is there, and then deploying that into your winners. I think that's one of the biggest lessons which is there. And obviously, from a market perspective, I think the lesson is tend to time the market. Right? You always want to catch the peaks of the markets at the bottom because you to maximize the return, because that doesn't really help. I mean, trying to time the market and understanding, okay, when is this thing, while we all try to make our guesses, but nobody is able to do that. So not timing, systematically investing into the market. Obviously, when there is real fear in the market, right? Because of some exceptional market circumstances or some crisis in the market, that's where you have to be really greedy and try to invest, right? So because we've seen that despite the ups and downs, the markets secularly tend to move up, right? So when there is a fear in the market, I think that's time one has to be really very, very aggressive, right? Do your research, and that's where you get the best value, right, for investing. I think these are the two lessons, broader lessons, which I think for retail investors, I think if they keep in mind, I think they should do reasonably well.
So you talked about working in Parak and Motil earlier.
Yes.
So how did your time at these renowned institutions shape your approach towards investing? So did the strategies you implemented in those firms, were they different from the strategies you implement in your current firm, that is ABS?
So I think each firm has different philosophies which are there. Right? In Parak it was more about value research, value investing, right? Looking at good value stocks, okay, identifying value. Then also that's where you got ingrained more into fundamental research, right? Do detailed analysis of companies, but clearly value companies, looking at those. Motilal Oswal was more about quality investing, right? Investing into good quality stocks, good management, company generating good cash flow. So that's how one started. That was the broader philosophy. So I think, and as you became as a fund manager, you need to manage different strategies and styles. So, but these are the basic fundamentals, right? Looking at value, right? Where is value in the market, and trying to look at those. Looking at good quality growth stock. Okay, those are not cheap. Yet you need to pay a premium for that, right? How to look at those, and when do you, how do you value those names with a slightly longer term perspective. So those were interesting aspects. Okay, obviously then you have to look at, when you're managing a portfolio, you also look at cyclical stocks, right? But you tend to build up a basket of various kind of strategies in one's portfolio. But these two are the core strategies, right? Value style and the quality and growth style of investing, which is the foundation for any long-term wealth creation.
Okay. So considering the influx of retail forces into the markets, how do you perceive the shifting market dynamics, particularly given the observation that many of these retail investors, they end up taking rational decisions, mostly FOMO-driven decisions. FOMO is fear of missing out.
Yes. So I think retail investors tend to look at past returns, right? They come in when they see the markets have done well. There is a lot more people want to get interested and try to do that, and they want to get the same strategy, right? Like what we have seen currently in the mid cap and small cap sector, they have done very well. More money is moving into that and trying to chase that. So that at times can be a bit tricky, because pure momentum investing, I think you probably tend to create tops and invest at the highs of the markets. So I think retail investors should tend to not be carried away, right, with the returns, past return, but look at more objectively, look at more fundamentals, right? I think, do some basic research, right, if you are investing into a particular stock, and see whether there is reasonable value which is there, right, rather than just looking at pure returns. I think that is what investors should look at. And a lot of new young investors who are coming into the market, right, we have seen a lot of early investors fresh from college or from their job trying to invest. I think they should again try to build up slowly a portfolio, say longer term perspective, right? Because when you are doing momentum investing and trying to look at returns, okay, there could be periods where there could be corrections in the market, and then that's when you tend to get out of the market, because you don't have the power to probably withhold, right? So try to get with a slightly longer term view. You should have a capacity to stay in the market even if there are market correction, and not be able to cash out, because once you do that, then you are permanently cutting your losses, right, and not ever ability to really bounce back.
So my next question is, in the current context, India's GDP is primarily propelled by government expenditure, with the nation's debt to GDP ratio reaching 81.6% in the fiscal year 23-24. Is this actually a matter of concern? So even though there are other countries whose
I don't think. I think our debt to GDP ratio is pretty well contained, right? Okay, because the government had to increase during the COVID period. You need to do a fiscal stimulus. Your fiscal deficit went down, but that's a temporary phase. I think our fiscal deficit is well compared to even some of the other developed markets, right, where they've really gone on and increased debt to GDP ratio. I think we are for a growing economy like India, our debt will be slightly on the higher side because government needs to invest, right, for growth. But as long as your growth is there, I think it will be able to service that debt. So I don't see that as a big challenge. And a lot of our debt is also more internal, right? We don't have foreign debt, right? Because we never really looked out of foreign debt, because then where it becomes tricky, because when they pull out money, that puts a lot of pressure, right, in terms of your balance of payments. So the good thing is that it is more internal debt, I think, which is that we're not dependent so much on foreign debt, and it is really manageable for the growth trajectory, okay, which Indian economy is likely to do.
So in the US, the inflation numbers exceeded consensus, suggesting that the economy may not be slowing sufficiently. This could result in higher interest rates, posing a potential headwind for the US stock market. Will there be any major setbacks in India if the numbers continue to be strong?
So I think, your interest rates cuts which we expected this year are likely to be much lesser, because US economic growth as well as inflation has come down, but it's still not really come down to a level which we are looking at. So as a result, you will see rates higher for a longer period of time, and that can lead to some shocks in the economy, right? There are certain sectors of the economy which could, because these are unprecedented rates. In India, we don't have that high rates because we never gave that kind of a stimulus also, right? So rates also were not cut to that extent. So there could be global shocks which can have some impact on our markets, but those are only transient impacts, right? I don't see our interest rates, right? They have not gone up too much, while the central banks have increased interest rates. They are at compared to our pre-COVID level, we are not very high over there. So I don't see that really impacting us much. Okay, obviously there are global shocks that could impact our equity markets temporarily, but again that will be temporary setbacks. Okay, we'll be able to bounce back from those.
So are there any particular sectors that you're bullish on at the current market valuations?
See, everything has moved up, right? There's been a big rally in the markets, but I think by and large, I think banking sector has valuation-wise looked reasonably well. Some of the large banks which are there, they are comfortably valued compared to the historical average, because not done all that well over there. Right? There are some certain sectors which have not done well in the last cyclical. Like they have consumer durables. If you look at discretionary, which has not done so well. So that I think India, you could see a much more secular growth as per capita income goes up, and consumer durable, consumer discretionary, I think that could do well. But most of the domestic sectors are doing, like auto sectors, outlook is reasonably good, especially two-wheelers and four-wheelers over there. Real estate sector is also looking good. Okay, we're positive on that. Pharma sector again has done well, but steady kind of a defensive sector to look at. So there are a few, like chemicals, for example, right, as a counter cyclical, that sector hasn't done as well in the last 1 year because of a lot of global inventory build-up which is there. But structurally, we see that specialty chemicals can be a good, where a lot of Indian companies can take a larger share of the global market over there. They have the capabilities, they have the technological capabilities which is there. So there are some of the sectors which think could do well. But by and large themes, I think, which we look at is banking and financials, consumer discretionary, right, even industrials and the investment related sectors, while they have gone up quite a bit, but outlook there looks fairly good.
So when it comes to defense, we talked about defense earlier. So
right.
You think that is something we can look for the next 5 to 10 years?
No, I think defense is good, but I think a lot of stocks have gone up crazy, right? So I would not be so comfortable, because you also have to buy stocks at the right price and valuation to make money, right? So there's a trade-off, right? Stocks are good, outlook is good, but valuations are very high. Then one has to be a bit careful over there.
So next question is, would you mind disclosing your current personal portfolio allocation?
Sure.
Just the percentage.
So I think I have always been an equity guy, right? I think if you have this, once your basic needs are taken care of, right? Okay, which you put money into debt for the next 1 or 2 years, all beyond that, I would say 80% of my personal would be into equities in one view, because that's where long term I see wealth creation. That's the only way to beat inflation and create long term wealth. So provided you have taken care of your short term needs, right, for short term fluctuations through your debt, and that's taken care of your, even if your regular income which comes in from your salary or PF money, which is takes care to a large extent. So I'm a long term large equity. Have got, probably you can say, have a higher risk appetite, but I know that long term, if you're doing sensible investing, you'll make reasonably good returns, right? And that's why bulk of my personal money is into equities, and most of it into mutual funds, right? Because being in the mutual fund industry, and with restriction, I think mutual funds are a good way to take care of your, because one wants to do a lot of direct investing and do that, but there are also pitfalls in that, right? Many times you lose money also. So mutual fund industry gives you a good way of diversifying your investments, and ability to, you can always, there are various mutual funds are there, right, to meet your risk appetite, and you can accordingly choose those funds to really meet your long term goals.
So how actively do you rebalance your equity portfolio?
Not really much, right? I mean, as I said, since I'm long term, long only equities, right, you keep on putting an incremental investment into equities, and only in certain peaks of the market when I think there is huge exuberance, okay, one would rebalance a bit. Like for example, currently we've seen good returns in the mid cap and small cap space. So you take out some money and then put more probably money into the large cap space, or the market looks very exuberant, then take out some money and put some money into liquid. But I mean, those are only at the peaks of the markets, right? Otherwise, I tend to hold on to my long term holding unless there is some fundamental reason to really sell that, right? A particular fund or whatever. Generally tend to hold and let it do well. I mean, despite some short term underperformance, I'm not too deterred because of that.
Do you have any particular strategies to deploy funds at the current market levels? Because pretty much everything has value.
Yeah. So I think at the current market levels, long term outlook is good. Short term, there could be volatility in markets is slightly run up. So the best strategy would be to put money into I would prefer at this juncture more towards large cap oriented fund within equities, large cap, flexi cap, large cap, flexi cap, or even some asset allocation funds, right? Because that gives a good mix across asset classes, gold, equity, debt. I think that's a good because the risk return we think across asset classes is fairly well balanced. So one can use there you can make some lump sum investment. Otherwise, SIP is the best way, right? To do that, or STP, right? If you have a lump sum money, to do a systematic transfer plan, and that's, I think, at these levels of market, I think that's what I would advise.
So my last question is on the same lines. So elections are around the corner, and there's a lot of noise around it. So, and there are a lot of people saving up to invest when there is a dip. Do you think that makes sense?
I don't know. I think waiting for a market correction, people have lost a lot of opportunity, right, over there, right? So they continue with their SIP. I think election outcomes can lead to short-term volatility, but I think we have seen that it doesn't really matter in the longer scheme of things. So I don't think you can always, because of uncertainty, you can keep some liquidity around there, but not much. Otherwise, continue with your normal SIP and SIP. I think that's the best approach in any kind of market environment.
So I don't want to take any more of your time. I'm sure you have a flight to catch. Thank you so much.
Thank you. Pleasure.